Well, let's take a look at the last couple of items. We are to the cash flow and balance sheet. This should be relatively short. There's not a lot of changes that you're going to make to these. Most of it should be self-filling, I guess you would say. On the balance sheet, if you notice, everything there is white, but there are a couple things we're going to have to change because of what we did to the amortization. The cash flow, let's take a look. Now, keep in mind that there's a first-year cash flow and then years 1 and 3, and I expect that you will have entries on each of those. Okay. First, we take a look at year 1. Again, just look at the orange ones. You won't have any entries for the white ones. You're going to have to look at some of the entries down here. But additional inventory, for the vast majority of you, you'll have no entries there. Okay, if you're running a retail place, coffee shop, something like that, might you want to bump up your inventory? If you're projecting increased sales, yeah, sure. Would it be every month? No, not necessarily. You could put in $500 here and $1,000 here, and years 2 through 3 you could do the same. Okay. But again, for the vast majority of you, that's probably not something that you'll even make an entry. If you got a service business, you don't really have any inventory, you certainly would not make any entries there. Owner's distribution. I definitely expect everybody to show some owner's distribution. The SBA would. If you submitted a loan application that was going to be through the SBA, they kind of require that. They want to know that the owner is taking something out. They have to feed their family, etc. Exceptions to that were if there was outside income. But for our purposes, yeah, there should be something in here. And this is where you might want to pay attention. If your ending cash balance, say, is tiny or nothing or negative, wouldn't be negative, your line of credit would kick in. But if it's small, let's say for the first 3 or 4 months, you may not pay yourself anything. That's understandable. Okay, but at this point, okay, maybe I have an ending cash balance of $1,500. I can pay myself $500. That, of course, will reduce my cash balance. Maybe I go along and I can pay $500 a month until here, and then maybe I can bump it up to $1,000 based on what that cash balance is. So you can kind of pay attention to that, and then at some point maybe it'll even out where you could pay yourself, $1,500 a month every month, when you get to, again, years 2 and 3 on the owner's distribution there. Line of credit repayments. Now this is truly, you do have to pay attention here. Many of you early on, and it's certainly not unusual, you'll show that there's a line of credit balance down here. Not unusual in the first few months. Okay, if that continues to grow month after month for both years, then you have other more serious problems. Then you're probably losing a lot of money, and you need to go back and make some adjustments to your sales and or your expenses, or both. Okay. But many of you might have a line of credit balance that gets started here early on. Very typical, very common for that to happen. But then you start accumulating cash. Your line of credit balance will stay the same, even if you're accumulating cash here, unless you do something about it, and that's where you would enter some money up here. Let me just see if I can kind of give you an example. I'm just going to plug in a number, and it doesn't really matter. Just kind of extend that so that it'll show you that I've got this line of credit. Okay, and it's also charging some interest, so I've got interest. Now, let's say in my sales forecast, let's just go sales price per unit 1, and my cost is 50 cents. Okay, and I'm going to sell a few of those here. Okay, and that's going to go along, and then I'm going to increase that to, okay, and that's going to go for a couple months, and then I'm going to increase that to there, and that's going to go along for a little bit, and then I'm going to increase that to there. This may be totally unrealistic. I'm not trying to be realistic here. That's going to now change my cash flow numbers. And as you'll see, my operating cash balance, ending cash balance 000. I start to accumulate some cash here, though, right? And it starts to accumulate decently. Now I still owe quite a bit here, but I got enough cash here that I could probably pay some of my line of credit down, right? So maybe I would apply $500 to that just to reduce the balance. Okay, it's fine. I still have a positive cash balance, and I've reduced that. And if I go look at years 2 and 3, I start to accumulate a little bit more cash. What happens there? Oh, because the months, in my sales forecast, I start with small months again here, and I may bump these up, and you could do that. Let's just do this just for the sake of it. So years 2 and 3 again, well, I'm still losing money, but here I start to gain again a little bit. I could pay these down then would be the key thing here. I got $1,600, maybe I want to pay it down $1,000. Am I ever going to get enough where I can pay it off? I'm not with my projections. Okay, but you will with your projections, hopefully. If not, again, you need to go back and redo it, like I would need to go back and redo it. I should go back and redo my sales projections, right, so that I would have a little bit more. Maybe if I went 400 here, maybe that'll be enough, right? Yeah, I'm still not doing too well here, okay, in these years. Well, that didn't make that much difference. Should have made a little bit of difference, but, well, I'm going to pause this thing. Yeah, I wanted to go back and change my sales so that I could show where it would be paying off here. I'm still pretty close, but we get to year 3, and you'll notice I'm down to $431. Actually here I've got plenty of cash, but here I've got way more than enough, and so I'm going to enter that 431. Okay, I still doggone it, I'm still building a little bit here, but by here easily I can pay that off, right, again. So I'll pay that 73 off, and then I have zeros the rest of the way. So mine's probably a little bit trickier, but I was just kind of throwing some numbers together there than what yours will be, at least hopefully. So that kind of does it for the cash flows. You take a look at that, go through, pay attention to what's on the bottom there. If you got some questions about it, swing it to me, and we'll see if we can get that figured out. What you'll find here, okay, on the balance sheet is that when you get this all done, year 1, if you've done everything kind of correctly up to this point, your year 1 is going to be balanced. It'll say balanced down here. Years 2 and 3 are probably going to be this bright, ugly red that says unbalanced, and it'll tell you how much you're off up there. If you look, the amount that you're off is probably going to be found in these cells, these 4 cells here, prepaid expenses and other initial costs. When I had you change the amortization of the startup costs to 1 year, okay, your balance sheet is still expecting those to be over 3 years, and so that adjustment wasn't made. And what you should do is just come here, hit delete on those 4 cells, and you'll come down and look, and at that point in time you should be balanced. Okay, if you're not balanced at that time, spend a little bit of time looking at it. If you really have some problems, ship it off to me. I can normally find those things fairly quickly, sometimes avoid you having to spend hours and hours. You'll learn a lot more if you spend those hours, but if don't let yourself get too frustrated is what I'm saying there, and I'm happy to have a look at it if need be. That should be it. That should get you through the cash flow and balance sheet. Thanks. Good luck.